Hi, I'm Jim Paris, and welcome to Living Financially Free. You know, the Bible has an awful lot to say about the subject of money, and for most of us, it would probably be the last place we would look for guidance when we're having financial difficulties. But you know, it should be the first place, because there is so much wisdom packed in this book about the subject of personal finances. You know, Jesus shared an interesting story in Matthew chapter 25. He talked about 3 servants who were entrusted with their master's money while their master went away on a long journey. To one, he gave 5 units of money. The second one, he gave 2 units of money. And to the third one, he gave 1 unit of money. So the master goes on the long journey and returns. And he asks for an accounting. And to the servant, he gave 5 units of money. They doubled their money to 10 units of money. The servant he gave 2 units of money to, yes, he doubled his to 4 units of money. Well, the story doesn't continue so happily, because the individual with the 1 talent, the 1 unit of money, buried their money in the ground and did nothing. You know, that's where most of us are at today. We have the least, so we do the least. We don't believe that we're accountable to God for the money that we've been blessed with. Well, during this video, we're going to talk about specific life-changing strategies that anyone can use to become a better steward of the money that God has blessed them with. Simple strategies like ways to save money on life insurance, auto insurance, how you can invest without ever paying a commission, how to be absolutely sure that your children can enjoy a college education and you can retire with wealth. It's all ahead on Living Financially Free.
Welcome to Living Financially Free, a video seminar that will give you and your family proven principles for financial freedom. Your host and teacher is James L. Paris, a nationally syndicated talk show host and certified financial planner. In the next 90 minutes, you will be challenged and educated about what the Bible says concerning money, how you can be a better steward of what God has blessed you with, and how you can live financially free. And now, here's Jim.
Living financially free. Well, it means different things to different people. And in this video, we're going to talk about specific strategies that you can use to live financially free. That's the name of my new book, which this video is based on. And later in this program, we will show you how to get your own copy of the book, Living Financially Free. But first, let's talk about what our responsibility is as Christians to be good stewards of the money that God has blessed us with. First of all, going back to the parable of the talents that we referenced earlier, Matthew 25, verses 14 through 30, we find 2 distinct principles that we learn from the parable of the talents. First of all, we know that regardless of the amount of money that we have to manage, we're accountable to the Lord. Regardless of how little we have, we are accountable. We learn this because as Jesus shares the story of the 3 servants, we find that the one who had the least did the least. Is that where you're at today? Perhaps you don't have much money, and so in your mind, you're not really accountable. Maybe you think you can't do much with what you have because it's an insignificant amount. Well, the Bible calls you to good stewardship regardless of how much or how little money you have. Secondly, we find that in this parable that Jesus is sharing, he refers to each of the individuals as servants or slaves. What does a slave own? What does a servant own? Nothing. Therefore, everything we own belongs to our master, who is Jesus Christ. Therefore, we become stewards. We become individuals who are managing property for someone else, in this case, the Lord Jesus Christ. In this video, we will talk about specific ways that you and your family can live financially free. So what is it that you want out of life? Maybe a new car, maybe a new home. Perhaps the security of knowing that you will retire with wealth rather than in poverty. Maybe for you, it's getting your children a good college education. Well, let me share with you some startling statistics. Did you know that the average American retires in poverty? Social Security currently is paying out an average benefit of just $650. Not per week, that's per month. Can you imagine being put in the financial predicament of living on just $650 per month. This is the case for many retired people in America today. 85% of Americans retire in poverty. Well, what about sending your children to college? Did you know that simply going through a 4-year college degree program can add over $1 million to the income of a typical American during their working career? $1 million. Talk about a sure way to put your children on solid financial ground by putting them through college. Well, these all sound like big goals: a secure retirement, college for my children, buying a new home, maybe a new car. How can these things all be done? Well, someone once asked me, Jim, what is the secret to financial success? Well, I'm going to give it to you right now. The secret is simple: setting goals, creating a plan to achieve those goals, and following the plan. It's really that simple. And anyone that you sit down with who has truly been successful financially will tell you that this is what they have done. They have taken a point in time and sat down and looked at what their goals were in life, created plans to reach those goals, and followed those plans. You know, recently a young man came into my office who was 25 years old, and he is what I would call a gold ribbon goal setter. And this individual said to me, Jim, I want to retire with $1 million when I reach the age of 65. So we sat down and we asked the question, how much does he need to put away each and every week to have his $1 million? So we ran the numbers, and he was startled. I was more startled to find out that all he had to save per week was just $21.25. That's right, just $21 a week between the ages of 25 and 65, and he would retire with over $1 million. Goal setting works with just about every aspect of our personal finances, whether it's buying a home, setting goals for retirement, or even putting away money each and every month so that our children can have a college education. You know that most people, if they started when their children were newborns, if they put away just $50 to $75 every month, by the time they were 18, they would have more than enough money to put them through a 4-year college degree program. You know, a lady once called on my radio program, and she said to me, Jim, I need help to be able to determine how I'm going to fund my youngsters' college expenses. My first question was, how old is your youngster? She said 17. You see, most of us wait until the last minute, until it's too late. Don't start planning on your 61st birthday or your 64th birthday for retirement. Don't wait until your children are 16 or 17 to start putting money away for their college education. Sit down right now, and if you're married, sit down with your spouse. If you have children, sit down as a family and have a family meeting. This would be a great time to stop the video and do some serious thinking. What is it that you want out of life? Maybe you've been told you can't dream. Perhaps you've given up all hope that you can have a better lifestyle than the one you have right now. Just for a moment, pretend that you do have hope. Humor me. Sit down and think about what it is that you want out of life. Maybe it's a new home, a new automobile, the security of $1 million retirement. Maybe it's knowing absolutely for sure that you will be able to have the money for your children to go to college. These are goals that can be achieved if you sit down now and you create a plan, and you stick with that plan, and you have the discipline each and every month to take the steps necessary to reach that plan. Here's what I want you to do. In addition to having a family meeting, take some quiet time in prayer and ask the Lord, is this what you would want for me? You know, many of us within the Christian community, we have a sense of guilt when we think about acquiring things like a new home or a new car or retiring with wealth. But nowhere in Scripture do we find that God commands us to be poor. As a matter of fact, some of the most wealthy people in Scripture were used most by God. Look at people like Abraham, Solomon, David, Job, who was wealthy, lost all his money, and was wealthy again. There is absolutely nothing wrong with a Christian having wealth. And the reason why most of us don't succeed is because we never take the time to sit down and set a goal, create a plan, and follow that plan. That's what goal setting is all about. So as I said, this would be an excellent time to stop the video and sit down and make some life-changing decisions, some goals about your future and that of your families. It's all part of what we call goal setting, and I highly encourage you to do it right now. Well, now that I've gotten you excited about setting life-changing goals, let's come back down to earth a little bit and talk about where you're at right now financially. You know, any financial planner worth their salt would first sit down with their client and help them to determine where they're at right now financially. The way this is done typically is by completing a net worth worksheet. What is our net worth? Simply stated, our net worth is all of our assets less our liabilities. For most of us in the early stages of our life, we may have a negative net worth. What that means is that we owe more than we own. But let's go back to the worksheet that you see right now on the screen. On one side of the worksheet, what we're doing is listing all of our assets, things like our checking and savings accounts, our investment accounts, the automobiles that we own, our home, other personal assets, perhaps art or collectibles. List all of the items that you own, total them, and that is what you own. Now, in column B, what we will do is list everything that we owe. These are all of our consumer loans, our mortgages, our automobile loans, our credit cards. After listing all of those, we add those up and total them. Those are our total liabilities. So how do we arrive at net worth? We simply take everything that we own, and from that, we subtract everything that we owe. For the purposes of this video, we will consider this to be our starting point, where we're at right now. You know, it's just like going on a vacation. If you're taking a driving vacation, you may, like most people, pull out a map. The first thing you'll do is look at the map and find where you're at right now. And then you'll find the destination that you're planning to travel to. And you'll simply sit down and route out the best plan to get from where you're at to where you want to be. Point A and point B. What's the easiest way to connect point A and point B? That's right, with a straight line or a good plan. So determining your net worth is a crucial part of this. You know, many people are afraid to sit down and do this. I think it, to some degree, is the same feeling we have about visiting a doctor. You know, I have an old saying that I've said for many years: the truth hurts, but not knowing the truth hurts even more. If you don't know where you're at financially, folks, you will never be able to make a plan to change your course to get in a better position than you are today. You've got to sit down and take an inventory of what your assets are, what your liabilities are, and what your net worth is, because your net worth is your starting point. And when we come back, we're going to talk about how to start from where you're at right now and take those specific goals that you've already set, your current net worth, and create some specific life-changing plans that you and your family can immediately implement. Well, I hope you're excited about where you're at financially, having now determined your net worth. I know for some of you, you may be somewhat frustrated. Maybe it's something you've never looked at before, what you're really worth financially. But you know, you can change that. This is just a starting point. Where you're at today really has little to do with where you'll be someday down the road. This is the point in the video where we really get down to brass tacks. We were talking earlier about what some of your dreams might be, perhaps that of a secure retirement, maybe college educations for your children, perhaps buying a new home or even a new automobile. We know where we're at now. We're at point A. We know where we want to be, point B. How do we get there? Well, we begin our financial journey with our financial compass. Well, that's what I call it. It's actually called a financial calculator. And this is one of the most important tools that we will use to chart our course to the final destination of living financially free. As you see the calculator now on your screen, you'll note 5 important keys: the N key, the I key, the PV key, the PMT key, and the FV key. Simply stated, N stands for time, I stands for interest rate, PV stands for present value, and PMT stands for payment, and lastly, FV stands for future value. Let's go through the calculation that we mentioned earlier in the program. Let's say you're 25, and by the age of 65, you would like to retire with $1 million. Well, how would we do this calculation? First of all, we need to determine our time. How many years do we have? We're 25 now and want to save money until we reach the age of 65. So we have 40 years. So let's go ahead and punch in 40 under the N key. Under the I key for interest rate, you would need to determine how much you believe you can earn on your investments. For the sake of this example, let's go ahead and use the long-term historical return of the stock market. Let's use 12%. So let's punch in 12 and then the I key. Present value, let's make that 0, assuming we have no money right now to start with. And let's punch in 1 million and touch the FV key, the future value key. Now we're asking the computer to tell us how much we need to save each and every month to be able to reach our future goal. Simply press the payment key, yes, and there's your annual figure, now divided by 12, and your monthly figure. You see, just about $85 a month is all it takes in this example for a 25-year-old to be able to invest for the future, to be able to retire a millionaire. This will work for college funding, it will work for a home purchase, or just about any goal for that matter. So let's review. First of all, determine where you're at. We know what our net worth is. We know what our current resources are. Secondly, let's talk in broad terms about our dreams, those things we'd like to have down the road, perhaps a new home, a new automobile, a secure retirement, or even college funding for our children. Now that we've determined what it is that we want, we must put a price tag on that item. How much will it cost? Not just in today's dollars, but in future dollars. One quick way to do this, for example with colleges, is to call some colleges right now and ask them what their current tuition rate is. Let's say that we're talking in terms of a newborn child. Let's say that the current 4-year tuition rate at the college you would like to send your child to is $50,000 today. Well, how do we know how much it will cost in 18 years? Well, you can look up at the library what the inflation rate is of various expenses, but I can tell you quickly that the inflation rate used by financial planners for college funding is about 7 to 8%. So you put the $50,000 into the financial calculator, we punch in 8% is our interest rate, or in this case, our inflation rate. We punch in 18 under N, 18 years, and now we know how much it will cost for a $50,000 college education in future dollars, 18 years from now. We simply then take this total and we go back to the first problem that we solved initially and follow the same steps. Take this total figure, put it in as our future value required, put in the number of years, 18, and the interest rate you can earn on your investments. For the sake of this analysis, let's use 12%. And there you see it. That's your annual figure needed to be saved, divided by 12. That's the monthly amount that you need to save to be able to reach your goal. The financial calculator, a very simple tool to learn how to use. This video may not have covered all of the elements of using the financial calculator. Most financial calculators, however, do come with a workbook which will give you even more examples and more instructions on how to use them effectively. You will also find further details and instructions inside the book, Living Financially Free. Well, now it's up to you. You've put together a specific plan. You know how much it will cost each and every month to fund that future goal, whether it's college education funding, retirement planning, or the purchase of a new home or even an automobile. You know what the number is. Now the only step left is for you to, that's right, follow your plan. You see, it's very simple. If you follow the plan that you've now created, you will reach your goals. It's that simple. Stick with your plan and you'll be successful. Well, banking in the 21st century, electronic banking, cash is easy to get. Dealing with banks can sometimes be difficult, however. Has this ever happened to you? Being turned down for a loan can be one of the most humiliating experiences one can endure. Without question, the #1 issue that is discussed on my nationally syndicated radio show is credit and credit repair. The frustration is real in the listeners' voices as they describe how they have been turned down for mortgages, credit cards, and even employment opportunities because of bad credit. Many have turned to credit repair firms and received nothing but empty promises, and most have been out and out lied to. I want to talk briefly about your 7 credit rights. These are rights that have been in place since the 1970s when Congress passed the Fair Credit Reporting Act. First and foremost, you have the right to dispute incorrect information that appears on your credit report. The bottom line, if it's not true, it cannot stay on your credit report. Number 2, you have the right to remove information that is too old to be listed. In general, most information must be removed within a 7-year period. In the case of bankruptcies, this information can stay on for as long as 10 years. Number 3, you have the right to add positive information to your report that for some reason may be missing. if you're paying your mortgage payment on time and automobile payments on time, and for some reason this information is missing, you have the right to force the credit bureau to add this information to your credit report. Next, you have the right to include a 100-word written response explaining your credit report, giving your side of the story, if you will. If there's something on the report perhaps that's negative and you're having a difficult time getting it removed, perhaps you can take an opportunity to explain to the credit bureau and any creditors that might inquire to look at your credit report why that circumstance happened. Perhaps it was because of a job loss, a medical crisis, or other financial circumstance that you were in. Number 5, you can force the credit bureau to re-verify all negative information on your credit report, even if it's true. And you know what? If they can't re-verify it, it must be removed, even if it's true. This can happen, for instance, in the case of a company that you've done business with in the past that is no longer operating. When the credit bureau attempts to re-verify this negative information, they won't be able to get a verification because the company is no longer around. Therefore, even if the information is true, it must be removed because it can't be re-verified. Number 6, review your credit file as frequently as you desire. That's right, it's one of your big 7 credit rights, the opportunity to look at your credit report as frequently as you want to. Now, TRW Credit Services will allow you 1 time per year to get a free copy of your credit report. The other 2 credit bureaus, TransUnion and Equifax, will require that you pay a small fee. On the screen right now, you will see the phone numbers and addresses for the 3 major credit bureaus, Equifax, TRW, and TransUnion. Typically, they will ask you to send a letter requesting a copy of your credit report with any required fee. You must then sign your name, include your address, and your Social Security number. You should get your credit report within approximately 2 weeks. And last but not least, your 7th credit right is the right to use small claims court to resolve any disputes that you have with the credit bureau. Small claims court is an excellent way to get the credit bureau to become cooperative in helping you to remove information from your credit report. If all of these strategies don't work for some reason, then as a last resort, I would contact the Federal Trade Commission in Washington, D.C. You see their number on the screen. They can start an investigation of that credit bureau's practices and force them to follow the Federal Fair Credit Reporting Act. Having good credit can be the difference between being able to own a home or renting for the rest of your life, being able to get good interest rates on credit cards and automobile loans, and getting the job of your dreams.
Well, by this point in the video, you should have already sat down and created your financial plan in terms of how much you'll need to invest each month to be able to fund your retirement. But now we answer the question of how this money should be invested. And you know, when it comes to investing, everyone has different ideas. You might wonder whether this money should be put in a savings account, a money market account, perhaps a CD, or even the stock market. Where should the money be placed? Well, part of the answer can be found in what you chose as your percentage interest in terms of how quickly your money's going to grow, and in your calculation, what you chose as the growth rate. As an example, if you, like most people, chose 10 to 12% as your growth rate, you will need to find an investment that will earn that on average year in, year out. Well, since 1926, the stock market has returned an average annual return of better than 10% a year. So that's where I would put my retirement nest egg. Now, there are so many different retirement investment options available. Let's talk about what I believe to be the best way to invest for retirement. It's called the mutual fund. And mutual funds provide us with 3 distinct benefits. Number 1, we can get started with a very small initial investment. Number 2, we avail ourselves to professional management. And number 3, we are in a situation to pay very, very low expenses. Usually most management fees at mutual funds are less than 1% per year. So now that we can get started with a small amount of money, what do? Where do we get started? Well, before we get invested in mutual funds, let's talk about what they are. The term mutual fund, which is heard frequently, is many times misunderstood. Let's start by taking the word mutual, and let's say that it's for our mutual benefit. That's right, mutual funds are simply a group of several thousand individuals getting together, pooling their money. Usually most stock mutual funds will have over 100 different stocks in their portfolio. So let's say, for example, that all you have is $10,000 to get started with. Well, you might be able to buy one, maybe two stocks. But with a mutual fund, you can own over 100 different stocks with your $10,000. That is why I like mutual funds. The diversification is outstanding when you're able to pool your money with thousands of other individuals. My favorite kind of mutual fund is a no-load mutual fund. Well, what does this phrase mean? No load, simply stated, means no commission. That's right, 100% of your money gets invested in the no-load mutual fund of your choice. Investing without a broker is the best way. If you use a broker, up to 8% of your money can go to brokerage commissions and will not get invested in your retirement account. Well, now that we've discussed the best kind of investment to use for retirement, let's talk about the best kind of account to use. Well, it varies for individuals on a case-by-case basis. But let's first start by talking about the company retirement plan. If your company makes available to you the opportunity to invest in mutual funds through a company 401k plan or other type of retirement plan, by all means take advantage of it. Most of these retirement plans provide the following benefits: an immediate tax deduction for the money that you contribute. Your money grows each and every year without being taxed. You only pay taxes when you finally take your money out of the plan and spend it and enjoy it. Thirdly, the company will usually match some percentage of your contribution. In some cases, it can be as much as 50% matching. What this means is $1 in your company retirement plan can grow to $1.50 on day one because of company matching. That's right, a 50% increase in your investment on day one because of company matching. So the very first place I would go with my retirement dollars is to a company 401k so that I can get the tax deduction, tax-deferred growth, and company matching all coupled with the power of no-commission mutual funds. Secondly, I would use an individual retirement account. An individual retirement account, depending on your circumstances, can also provide a tax deduction, but in any case will provide tax-deferred growth and also can give you the opportunity to buy no-load mutual funds. Call the IRS at 1-800-829-3676 and request publication 590 to determine whether investing in an IRA will give you a tax deduction. Typically, if you're married and your adjusted gross income is less than $40,000, you should be able to get a full tax deduction for putting your money inside an IRA account. However, even if you're not entitled to the tax deduction, I would still make the contribution because your money will grow on a tax-deferred basis. The best place to open up your IRA account? No, not at a bank. My suggestion would be one of America's best no-load brokerage accounts, like Charles Schwab. They have a one-source account that will allow you to invest in over 600 no-commission mutual funds inside your IRA account. You may also check with Quick & Riley or Fidelity for other options that are available. But usually the best place for this kind of account is at one of the nation's largest no-commission brokerage firms, like a Charles Schwab. Now, let's talk briefly about the third option. Let's say that you fully funded your 401k plan, you've fully funded your IRA account, and you still are looking for places to put your retirement dollars. My suggestion, a tax-deferred mutual fund investment. Although you do not get a tax deduction for putting your money in the account, it will grow on a tax-deferred basis. If you call my office at 1-800-950-PLAN, I would be more than happy to send you free of charge information on 2 or 3 of the best tax-deferred mutual fund accounts in the country. You will be able to put an unlimited amount of money inside these accounts. It will grow tax-deferred, and you don't pay taxes until you take the money out to enjoy it. A couple of negatives, however, that I should mention briefly about the tax-deferred mutual fund account. One, if you take the money out before you're 59 and a half, you will have to pay a 10% penalty. And secondly, most of these plans do require that you keep the account for a minimum of 6 years without pulling the money out, or you will be subject to a small company penalty, usually somewhere between 3 and 6%. Well, now that we've got started with this segment of investing for retirement, I hope you'll act on this information and go out and start funding your company 401k plan, that you immediately open up an IRA account and start buying no-commission mutual funds. And if you've done both of those and still need a third place to invest, that you call my office to get information about a tax-deferred mutual fund account. You're only a few steps away from living financially free. college education for our children. Certainly a dream that most of us share. It'll be difficult, however, for many people to afford a college education for their children because of the skyrocketing costs of college tuition. Annual estimates show us that the cost of college tuition is increasing at an annual rate of between 8 to 10% a year. It can be easy, however, to assure your children a college education if you start early with the right plan. Although it has been said that a college degree can be the best gift you can give your child, the dream of providing this step up into the world is fast becoming out of reach for the average American family. The biggest challenge is that the cost of tuition is now rising at a rate more than double that of the inflation of consumer goods. 8 to 10% annual increases in tuition have become the rule, not the exception, in recent years. A four-year college degree at Harvard University is estimated to cost more than $210,000 in just 18 years. Notre Dame University, $176,000. So how do well-meaning parents possibly keep up with these kinds of rising expenses? The only answer is to start early and save something each and every month. For most, college tuition can be saved in advance by depositing between $50 and $100 each month from the day your child is born. It is never too late, however, to get started. Every day you wait, it simply gets more difficult. Look at the current expenses of some of America's most well-known colleges. The sad reality is that most of our children will only barely make it through college with loans and part-time jobs if they make it through at all. Your child's college years can be great ones if you plan now to begin saving each and every month, and remember that by helping them get a college degree, you are making a great investment, since on average, they will earn an additional $1 million during their working career. An additional resource for those of you who may have already waited too long is to contact the National Scholarship Research Service at area code 707-546-6777. They make available a number of resources on the subject of college grants and scholarships. Grants and scholarships, unlike loans, do not need to be paid back. There is a reported $25+ billion of private scholarships being offered each year. The National Scholarship Research Service has numerous resources to help you and your youngster get your share of the college scholarship and grant pie. Take note of the following additional resources that are available to you for the purposes of finding scholarship money.
Well, we've been talking about mutual funds, and I wanted to take an opportunity to kind of stop now and answer some of the most commonly asked questions that people raise on the topic of mutual funds. The first question that I get is, Jim, how do I choose the right mutual fund for me? In America today, there are now over 5,000 mutual funds out there, and it can be quite a difficult task to choose the one that fits your situation and your temperament. So let's talk about this briefly. First of all, you want to eliminate any fund that charges a commission. Any mutual fund that charges what we call a front-end load really should be eliminated from the beginning. Why? Because we want 100% of our money to get invested, not just 92 or 95% of the money. So once we've eliminated all of the commission funds, we're left with the no-load or the no-commission funds. Well, still quite a task remains because there are still several hundred no-commission mutual funds available. So you want to start by looking at two different factors. One is, what is your current circumstance? Do you have a long period of time to invest for what your future goal is, or a short period of time? Generally speaking, if your investment time frame is, say, less than 2 to 3 years, you probably should invest strictly in a money market account and not in a mutual fund. Why? Because in that short period of time, it could work out that the day you need the money, maybe for a down payment on a house or some other short-term goal, the market may be down, and therefore it may be an inopportune time to pull the money out. You may even, in some cases, absorb a loss. So you want to look at your time frame. Traditionally speaking, financial planners would advise that the longer your time frame, the more volatile or aggressive fund you can purchase. Now, when you get the fund's prospectus, which is the basic information document that they will send you when you inquire about investing, there will be information inside this prospectus document regarding the risk of the fund. You want to always be sure that your risk tolerance is equivalent with the fund's risk objectives. If you're going to invest fairly conservatively and you get the fund in prospectus and it talks about aggressive growth and small cap companies probably it's not a good fit for you. So you want to look for a fund that meets your objectives as well as your goals. And be very careful and take the time to read the prospectus fully. There is a lot of information in there. I know sometimes it can become overwhelming, but it's a good read and it will give you a foundation for understanding where you're investing your money. The second question is, Jim, you mentioned that mutual funds are diversified. In some cases, maybe 100 to 150 stocks are represented inside a mutual fund. So is there ever a circumstance where I may want to own more than one mutual fund? Well, the answer is yes. Even though mutual funds inherently are diversified in their makeup, as I mentioned earlier, in some cases 100 to 150 stocks are in a stock mutual fund, it still would make sense to begin to split your money up after you reach certain levels of dollars that were invested. As an example, if you had, say, $10,000, you may want to limit yourself to maybe 1 to 2 mutual funds. 20 to 25,000, I might increase that to perhaps 3 to 4 mutual funds. Maybe 50,000, you want to look at maybe 4 to 5 funds. No more than 7 to 8 funds, however, should be in your portfolio, in my opinion, regardless of how much money you have invested. The problem is it is very difficult to track your investments on a month-to-month basis if you're invested in 20 to 30 different mutual funds. I remember the story of a client who came into my office about 2 years ago, and he brought in all of his investment statements, which numbered, believe it or not, 50. And as he began to share with me his investment strategy, it really was quite shocking to look at what his task was on a monthly basis to track his investments. What he had to do was to literally review 50 statements. Every month he had to look in the newspaper to get the prices for 50 different investments, and it was really a very tedious task for him. So although mutual funds are already diversified, I think the argument can be made that it does make sense to expand to maybe more than one fund, maybe up to 5 to 7 funds, depending on the amount of money that you invest. I certainly think, however, that more than 7 to 8 funds really would become counterproductive, and you may become over-diversified, which is a term that's used in the financial planning industry to describe a situation where a client may simply own too many investments to where they're not able to track any one investment very carefully. The next question is, Jim, how important is track record in determining a mutual fund's future success? Well, you've heard the old saying that past performance is no guarantee or indication of future performance. I think we have to realize that it truly is not a guarantee of future performance, but at the same time, it certainly can be a fair indication of future performance. Let me tell you what I mean by this. Just like in sports, we tend to see the same teams every year ending up in the playoffs. They may not win the Super Bowl, but they're going to end up in the playoffs usually year in, year out. We get some indication of a company's management and ability to invest money wisely by looking at how they've done long term. If the company has a very good long-term track record, well, it does not guarantee absolutely that they will do well in the future. It certainly is a strong indication that we're dealing with a winning team here. One key consideration, however, is to look at the issue of management. If the manager has changed recently, the track record of that fund should not be considered as strongly in making your decision. The individual who is calling the shots, who is choosing the investments, if he's no longer there, although the track record still should be considered to some degree, it should not be given the weight in your decision as it would if it was the same manager, say, for the previous 10 or 15 years with a tremendous track record. You should consider the new manager's track record as well as that fund's past track record. Although most mutual fund managers do not have full and complete say regarding the investments in the portfolio, they do have the majority of the say and the majority of the authority. So you want to track the manager as closely as you do the mutual fund company. Next, Jim, can I invest in mutual funds that focus on specific industries? Now, I get this question quite a bit from people who are very interested in certain industries. As an example, a recent caller on my radio program raised the issue that he felt that the future of the economy was really linked to computers and technology, and he wanted to know how he could invest specifically in computers and technology, but yet stay within mutual funds. Well, there are special kinds of mutual funds known as sector funds. These funds invest in specific sectors or industries. And what this means is that you can invest, for example, in all computer stocks. Although you'll have a diversified portfolio of many different computer stocks, you still will be in that sector or that industry exclusively. These are called sector or industry funds. You will find a wide variety of these available at Fidelity. And you see their number right now on the screen, 800-544-8888. Also, Invesco has a number of sector or industry funds, 1-800-525-8085. Now, the key is, in using sector funds or industry funds, we want to be careful to understand going in that these funds will probably be more risky and more volatile than a typical stock mutual fund that's diversified among many different industries. So for most people, this should not represent more than, say, 20 to 25% of your overall investment holdings, unless you're someone who's willing to take a great deal of risk. I hope these answers to some of the most common questions that people ask me about mutual funds have been helpful to you. Life insurance, in my opinion, is death insurance. That's exactly what it does. It protects us against an untimely death, primarily of a wage earner in a family. Now, many people will say that children need to be insured for $50,000 or $100,000. Nothing could be further from the truth. My opinion is that children should not be insured. Now, some people have asked me at my seminars, Jim, what do we do if one of our children dies and we have to pay for burial expenses? Well, what you can do is, in terms of a small policy, you can add on what's called a rider, which could be a $5,000 to $10,000 small policy that you can attach to your own life insurance policy. It's called a rider policy, and these are very, very inexpensive and will certainly more than cover the expense of a burial, of the untimely death of a child. And that really is the only reason that a child should be insured with life insurance. Now let's talk about the amounts of life insurance that we might buy on the adults in a family. And then in a few moments we'll talk about whole life versus term life insurance and maybe settle that disagreement once and for all. What we want to do is, starting with the primary wage earner in a family, making the assumption that there is one wage earner in a family, what we want to do is take that wage earner's income, multiply it times 10. And as you see on our screen, in the example, $30,000 a year income times 10 is $300,000. This is the face amount of life insurance that we need to buy on a primary wage earner. Why? Where do we come up with this amount of 10 times the annual income? What you want to do is be able to have a lump sum of money that's large enough so that once it's invested at 10%, it would replace that income. So $300,000 invested at 10% produces, that's right, $30,000 a year in income. So this is how we determine how much life insurance is needed on an individual who is the primary wage earner. Now this calculation can be used also in families where there are two wage earners. You simply would take the other spouse's income, multiply it by 10, and that would give you the amount of life insurance to purchase on the other spouse. Now there is a tricky situation that occurs when we have a scenario where one spouse is out in the workforce, the second spouse is at home with the children. The question comes up, should the stay-at-home mom be insured in terms of life insurance? The answer is absolutely yes. Let me use my own family as an example. I have 3 small children, and as my wife puts it, she works in the home. I've made the mistake of saying before that I work and she doesn't. I'll never say that again. But she works at home, taking care of our home and our children. So what we did was we sat down and asked this question. If something were to happen to her, how much would we need on an annual basis to replace the domestic services that she provides to our family? Well, we determined that the number was $25,000. So what did we do? We multiplied $25,000 by 10. We went out and we purchased $250,000 of life insurance. Why does that make sense? Well, again, if we take the $250,000 and invest it, earning 10%, we will create an income stream of $25,000 a year, enough money to hire a nanny, an individual to take care of the home and the children. And that's important, to be able to plan and anticipate what these unforeseen circumstances might cause in terms of difficulty in each of our lives. You know, the most tragic circumstances that I face as a financial advisor is when I'm called into a situation where a spouse has died, and I'm there to advise the spouse that's been widowed as to what they should do with their investments and their finances. And you know, there's no situation that could be any worse than being in that circumstance of the person going through the circumstance of a person that you've loved just dying, and then on top of that facing the grueling decisions and the tough challenges that are ahead of you. But you know, what makes it even worse is when that spouse is left with nothing in terms of any life insurance benefit or any investments. Many times quick decisions must be made about that spouse even before they've begun the grieving process, going back into the workforce, getting some daycare services in place for the children. So when I talk about life insurance, folks, realize I am very, very serious. You should have the proper amount of life insurance in place to protect you and your family. Now, the primary reason why most people do not have the correct life insurance in place is because they get their advice on insurance from insurance salespeople, commission-based insurance salespeople. What happens is this: they will sit down with an insurance agent who will advise them that purchasing $300,000 of life insurance will cost them $2,000 or $3,000 a year. immediately the reaction is, hey, I can't afford that, so I'll settle for 20 or 25,000. Let me explain to you briefly the best way to approach the subject of life insurance, how to buy life insurance in some cases for as much as a 90% discount off of what you would pay for whole life insurance or cash value life insurance. It's simply called term life insurance. And as the phrase denotes, term covers you for a specific term, typically 1 year. The kind of life insurance I suggest and recommend is called ART, Annual Renewable Term. What this means is that on an annual basis, you are guaranteed that you can renew the coverage if you desire to do so. One of the arguments against term life insurance is although it's inexpensive when you're younger, it becomes too expensive when you're older. So you should buy whole life insurance. The problem with whole life insurance, folks, is that it really is, at its face, a misrepresentation to the consumer. The big plus of whole life insurance, we are told, is that inside the policy is building an accumulation of dollars, an investment account, if you will. And the benefit is that not only are you getting life insurance, but you're also building this amount of money inside the policy that you can dip into at a future date and use to do things like pay for your children's college education, maybe supplement your retirement. The problem with that philosophy is that the accumulation or investment account inside a whole life insurance policy is never yours. The only way you can get it is to take a loan and pay interest to the insurance company, or surrender the life insurance policy altogether, which in many cases is not a good decision either. So the accumulation account, the investment account, is never really yours. How much more expensive is whole life insurance than term? Well, in some cases that I've seen, it can be as much as 8 to 10 times more expensive than basic term life insurance. Let me give you a quick example. A 30-year-old non-smoker in good health can purchase over $350,000 of quality term life insurance for about $1 a day. And I really want you to understand how inexpensive it is to buy quality term life insurance. Now, you can get these rates locked in for a period of 15 to 20 years in some cases. The idea is, and this is what the whole life insurance salesman will tell you, that you're going to need life insurance for your entire life. But the idea is this, that if you buy term life insurance and you take the difference in premium, which can be hundreds if not thousands of dollars difference per year in premium, you take the difference and invest it in mutual funds, as we've been talking about throughout this program. By buying term and investing the difference, you can build up your own net worth to a point where you won't need life insurance. Let me tell you what this means. There will come a time in your life where your net worth reaches a point where even if you were to die or your spouse were to die, there would be more than enough money already set aside in your own reserve account to cover this eventuality. In essence, you would become self-insured. This is really the goal when it comes to life insurance. We want to buy life insurance when we're younger and we need it and we've got the exposure. But as our children get older and they reach college age and they move off and go into their own lives and our risk is lessened there, and also as our own net worth increases, we want to decrease the amount of life insurance that we have. And eventually the goal would be to have no life insurance. Now that's a scary thought, to have no life insurance, but just think about it in these terms. The purpose of life insurance is to replace lost income. So if at some point you become retired and you're living off the income from your investments and pensions, if you were to die, your spouse would still have most of that income. So the idea of replacing that income, there's really not a need to do that. So there's no real purpose that life insurance serves once we reach retirement age. This is one of the big reasons why people emphasize whole life insurance. The concept being that you need life insurance for your whole life. You really don't. And the easiest way to remember the correct kind of life insurance is that when you buy whole life insurance, it's just like throwing your money down a hole. That's right, you'll probably never see your money again, and you're going to pay as much as 10 times. Here's what I'm going to do for you. As a purchaser of this video, if you will call the 800 number right now that you see on your screen, 1-800-LIFE-560, you will reach my insurance division. Tell them that you're a viewer of this video. They will send you out a free life insurance comparison, which with our computer database, we can compare the cost of term life insurance comparing over 170 different term life insurance companies. It's absolutely a free service to you as a viewer of this video, and we will send you a complete printout telling you which term life insurance company has the best price for you and your circumstances. So let's quickly review. Most likely, your children do not need life insurance. Secondly, you should be insured for at least 10 times your annual income. If there's a non-working spouse that stays home and takes care of the children, they should be insured for 10 times the annual expenses it would take to replace those services. And remember, the best way to approach life insurance is to buy simple term life insurance
and invest the difference in your powerful investment program, mutual funds. Well, one sure area of your budget that can stop you from living financially free is the cost of auto insurance. One of the easiest ways to save money on auto insurance is before you make a decision to buy an automobile, be sure that you know how much it will cost to insure that car. A sports car like this model would cost probably 2 to 3 times the expense to insure than that of a family van or other vehicle. So one of the surefire ways to save money is before you go out and buy that sports car, be sure that you can afford to insure it. Secondly, when it comes to insurance, whether it's auto insurance or any kind of insurance, it pays to shop around. Listed on the screen right now are the 5 best auto insurance companies in the country in terms of dollar value for the money that you spend on your premium. You'll see phone numbers listed, or if it's more convenient, you can simply go to your Yellow Pages and contact a local office. These companies, in a recent national survey, were determined to be the best value for auto insurance in America. Well, what are some of the other ways we can save money? Well, what about taking some of the risk on ourselves when we insure our automobile? What am I talking about? I'm talking about raising our deductible. As an example, if you raise your deductible to $500, your auto insurance premium will drop by 25%. If you raise your auto insurance deductible to $1,000, your premium will drop by as much as 50% just by changing your deductible. Now, a lady in one of my seminars, she said to me, Jim, that means if I get into an accident, then the first $1,000 is on me. Well, that's correct. You're taking that portion of the risk. So you would have to pay the first $1,000 of any damages that were done in an accident that you were involved in. However, think about it in these terms. Your monthly premium would be so much higher if you had a lower deductible that if you didn't get into an accident every year to a year and a half, you'd end up paying the deductible anyway because of your premium being higher. Now, someone in one of my seminars said, well, Jim, that's me. I do get into accidents every year to a year and a half. And my answer to them was still follow my strategy, raise your deductible, and use your savings for driving lessons. So in any case, the strategy works for everyone. Now let's talk about those of you who may have older automobiles. My strategy is that once the value of your automobile drops below $2,000, you drop the comprehensive and collision coverage. What does this mean? Well, what it means is that you're no longer concerned about your car being destroyed in an accident. Why? Well, because the cost of insuring it would be so great that unless your car was totally demolished once a year, it would make no sense to buy this kind of coverage. So my strategy is when the value of your car drops below $2,000, drop the collision and comprehensive coverage. Always, and I want to emphasize this, always keep full liability coverage on your car. Not only because it's the state law in most states, but because regardless of what kind of clunker you're driving, you still can damage someone else's car or hurt another person. However, the best way to buy liability insurance coverage is to buy the minimum required by your state in your auto policy and then go to your insurance agent and ask him to issue an umbrella liability policy. What this simply means is that where your auto insurance policy liability ends, an additional policy picks up. It's called umbrella liability, and usually it's only about $150 to $200 for an additional $1 million of liability coverage to be stacked on top of your auto insurance liability. Now, after you've done all these things, there are still some small steps that you can take to even save more money on your auto insurance. Pull out your auto insurance policy and review all of your coverages and ask this simple question: do you need each element of that coverage? For example, on most auto insurance plans, you will pay between $5 and $10 a month extra for a benefit known as towing and rental car coverage. What this means is if you're in an accident, the company provides for you, free of charge, a rental car. They will also tow your car from the accident free of charge. Well, these are nice coverages to have, but they're really overly priced in the policy. So my suggestion, get rid of all the bells and whistles. Before you buy your new car, be sure it's one you can afford to insure. Maybe buy a used car. If its value is $2,000 or less, drop the collision and comprehensive altogether. And try, most of all, to carry higher deductibles so you can save the most on your auto insurance. Medical insurance. Well, it's been the subject of recent national debate. The average family of 4 faces a bill of several $100s per month in expenses to buy medical insurance. If you're one of the tens of thousands of families that does not have employer-provided health insurance, it may be very difficult to find it affordable. A client of mine recently informed me of his situation. He went without health insurance for just 30 days. And in that 30-day period, he and his family absorbed over $150,000 of unexpected medical expenses. The risk is great. The cost of medical insurance is great as well. So what do? Well, follow my simple 7 strategies to increase your ability to buy health insurance and keep the costs low and affordable over your lifetime. You've got to have it, and here are some quick ways to make it affordable. Freedom Principle. If you can't afford a full coverage insurance plan, buy a major medical plan with a high deductible. Most people do not decide between a Mercedes-Benz or walking when in need of a car. Oddly enough, this is how most people approach health insurance. There is the Mercedes-Benz of health insurance, which features such extravagances as low deductibles, prescription drug reimbursement, eyeglasses, dental work, and of course, major medical coverage. If one desires all of these bells and whistles and yet cannot afford them, should they go totally without health insurance? Of course not. The sad fact is that many do. The answer is to carry a high deductible, perhaps as high as $5,000, to make health insurance affordable for you. Yes, it is true that the first $5,000 of expenses will be on you, but at least you've eliminated the catastrophic risk of unlimited medical expenses that could burden you and your family for a lifetime. Freedom Principle. Join a professional trade association to become a part of a group health insurance plan. Although the principal benefit of joining an association is to benefit from the valuable sharing of information between members and the attending of conventions, etc., one valuable benefit, many times overlooked, is the availability of low-priced group medical insurance. If you're not a part of a group, join a group. Freedom Principle. Purchase prescription drugs mail order. Some Americans spend hundreds of dollars per year on prescription drugs. If you are in need of a prescription drug on an ongoing basis, why not buy it from a discounter? Listed on your screen are organizations that will fulfill your prescription drugs via mail order at about a 50% discount. Freedom Principle. Purchase contact lenses through mail order discounters. Contact lens distributors can save you more than 50% when you buy direct. The 2 most prominent companies are listed on your screen. Freedom Principle. Negotiate, negotiate, negotiate. Being a good consumer does not stop as you enter your doctor's office. Many times a doctor may recommend a series of routine tests, assuming you have full insurance coverage. By simply explaining to them that you are utilizing a higher deductible to save money on your insurance, they may rethink the number of tests that are actually needed. Other examples of this may be to inquire about outpatient surgery rather than staying overnight at the hospital. Additionally, many surgical procedures can be done numerous ways. For example, some more advanced procedures can shorten recovery time dramatically. This is a plus. However, it may cost thousands of dollars more for a week less of recovery time. The point is to work with your doctor and explain your financial circumstances in advance so the best plan to meet your medical needs and budget can be worked out. Freedom Principle. Get free medical advice. Yes, it's true. There are literally hundreds of organizations anyone can call and receive free advice on any number of medical issues. Listed on your screen are just 4. Contact your local hospital to find out about free medical help hotlines that are available in your area. And last but not least, Freedom Principle. Let me help you find an inexpensive health insurance plan. Call the number on your screen and ask for a free medical insurance quote. My company literally compares the cost of dozens of health insurance plans on a daily basis. Call 1-800-LIFE-560 for a free medical insurance quote that will be sent by mail. Automatic investing. It gives each of us an opportunity to build wealth for the future automatically. Let me explain. When you set up a mutual fund account at your favorite mutual fund, and right now on your screen you'll see 3 of my favorite, Invesco, 20th Century, and Fidelity. You can request an automatic draft to be taken from your checking or savings account each month and deposited automatically in your mutual fund account. Let me explain to you why this works and why it makes a lot of sense. You know, as I travel around the country doing seminars and my radio broadcast, one of the common themes that I hear from people is that, Jim, hey, I can get excited about funding my retirement, paying for my children's college education. It's easy to have that initial excitement and that adrenaline rush. But the problem is, a year later, 2 years later, when it's month after month after month of making that payment into my mutual fund account, sometimes I tend to lose excitement. And you know, if you have a tight month financially, it might be easy to get off track and maybe look at perhaps using some of that money to do something else besides funding your investment account. So my suggestion is this: make it easier to succeed than to fail. Let me say that again.
make it easier to succeed than to fail. What do I mean? When you open up a mutual fund account, in most prospectuses and applications, you will find an additional document called an automatic investment draft document. What you need to do is complete that document, and then here's what happens. On the same day every month, automatically, right from your checking or savings account, your investment is funded. That's right, automatically. You do nothing. And as a matter of fact, it takes more time and effort to stop this from happening than to just let it happen. So what we're in essence doing is we're using our own laziness kind of to our advantage, because in order to stop this investment draft, you might have to make 2 or 3 phone calls, fill out a letter, maybe an additional document in some cases. So it's a lot of trouble to stop this. Now let me tell you what has happened. As I've traveled around the country and done seminars, people who have never saved before in their life have come up to me a year or 2 or 3 years later after setting up an automatic investment plan and informed me that for the first time in their life they were actually building wealth. And it works, and it's simple, because all you need to do is fill out an additional document when you initially fund your mutual fund investment. On the same day every month, automatically, money will come out of your savings account or checking account and go right into your investment plan. And it works. It works for thousands of people around the country, folks. I know it works, and I want you to take some time right now. This may be a great time to stop the video and think about putting your plan in action. We talked earlier about deciding how much money it would take to fund your children's college education in terms of a monthly investment amount. We talked about retirement planning in the same way. But now it's time to really let the rubber meet the road, where we have to start implementing, taking action on this information. And I'll tell you, it makes a whole lot of sense to let the action take place automatically. Let's make it easier to succeed than to fail by using automatic investing, one of America's most powerful investment principles.
Well, the biggest challenge for most people in their personal finances is not spending more than they have to spend. Well, here we are in a mall, and it seems like shopping and credit go hand in hand. And the national media tells us that the average American is now carrying more than 5, count them, 5 credit cards, with an interest rate on average in excess of 18%. These are certainly difficult and challenging economic times in which we live. Let's start first of all and talk about what the Bible has to say about debt. In Proverbs 22:7, we read that the borrower becomes the lender's slave. Are you watching right now perhaps saying, wow, that really describes my circumstance? I'm in financial slavery or financial bondage. The second thing we know the Bible says is that in Psalms 37:21 we learn that the wicked borrows and does not pay back. Well, many teachers on the subject of biblical finances have done a tremendous job of vilifying credit cards. I'm here today with a balanced perspective for you. I think credit cards are a tool that can be used wisely or abused, and that really depends on you. What are some of the danger signs? Well, if on a monthly basis you're not able to pay off the balance in full of your credit cards, you could be well on the path to financial destruction. Let's talk about one of my most famous credit card strategies. It's helped literally thousands of people around the country to take control of their credit card debt and start working towards paying it off. It's called the Triple Punch Credit Card Strategy, and it works very simply. Number 1, obtain one of America's lowest interest rate credit cards. And on your screen right now, you'll see 3 suggested banks. All 3 of these banks offer Visa and MasterCards with an interest rate of less than 10%. Step number 2, take a cash advance on your low interest rate credit card. And step number 3, use that money to pay off a high interest rate credit card. In essence, what we've done with the Triple Punch credit card strategy is we've refinanced our high interest rate credit cards down to low interest rate credit cards. Well, what's the benefit of doing this? If you follow this one simple strategy, you will drop your payments by 35 to 45% immediately just by changing credit cards. Now, here's a little known fact. The average American with these credit cards will pay between 17 and 27 years before getting out of debt on a credit card by making just the minimum payment. Your strategy, move to one of my low interest rate credit cards and make the same payment as you did on your old high interest rate credit card. By making the very same payment, even though you could make a lower one, but by making the same payment as you did on your old credit card, on your new low interest rate credit card, you will pay it off in less than 3 years, saving you between 14 and 24 years of payments just by switching to a better credit card. Now, let's briefly talk about the 2 quick strategies that anyone can use to pay off credit card debt. The first method is known as the lowest balance method. The way this works is you go to the credit card that has the lowest balance. You take all of your surplus money and you use that to pay off this credit card. Once that credit card is paid off, you move to the one with the next lowest balance. The theory behind this is that it gives you a sense of accomplishment having paid off one balance after another after another. The second, and I think more practical approach to this, is to use what's called the highest interest rate method. The highest interest rate method says you start with a credit card or consumer loan that has the highest interest rate, and what you want to do is begin to pay on that card first until it's paid off. The theory being the most expensive credit card gets the most money paid towards it. Those are the two methods to get out of debt. I highly suggest that you get one of the low interest rate credit cards that I suggested and use that money to pay off a high interest rate credit card. I also recommend that you use one of my two methods, either the highest interest rate method or the lowest balance method to pay off your credit cards. Getting debt-free, at least paying off your credit cards, is a very significant step towards living financially free. Well, certainly one element of the American dream is owning a new car, but the cost of new car ownership has gone up dramatically in the last 30 years. In 1965, the average new car sold for just $3,500. Today, to own a new car will cost you more than $20,000. That's just a basic model without a lot of the extras. It can certainly be expensive, but by following these strategies, you too can buy a new car and make it affordable. Getting a good deal on a new car is certainly a challenge that we all aspire to. It can be difficult and frustrating to say the least. The only real way to know that you're paying a fair price for a new or used car is to find out its value before beginning your negotiations. Such guides as the NADA Yellow Book, the Kelley Blue Book, or the Edmunds New Car Guide can be excellent resources so that you will know that you are paying fair market value for the car that you purchase. Also, say no to expensive add-ons like rust-proofing, credit life insurance, fabric protection, extended warranties, and other so-called add-ons that will be offered to you at any new or used car dealership. For most people, the best way to save money is to buy used versus new. Typically, a new car depreciates 30 to 40% in its first year of use. Your best strategy is to let someone else absorb this loss, not you. Buy a slightly used car and enjoy big savings. Leasing. Leasing is not as expensive as buying, some may say. The real truth is that the cost of leasing can be very expensive, much more expensive than buying. Many people who are lured into leasing by the attraction of a lesser payment find out the truth too late. The truth that leasing is usually more expensive than buying a car. Such hidden expenses as mileage overage penalties, penalties for excessive wear and tear, etc., can prove to be expensive. Additionally, leasing a car will leave you with a perpetual car payment literally forever. You will never build up equity in a car or even come close to owning one without payments. An additional way to save money on your next new car is to buy it from a government auction. Use these following resources. Buying a new car can be difficult, but by following these proven principles,
can do it easily and painlessly.
One of the largest elements of the American dream is, yes, the dream of owning our own home. There's just something about the idea of owning our own home and the land underneath it that has a sense of security to it, and probably is the largest component in the American dream in terms of clients that I work with on a regular basis. But one of the big questions that this raises is, how quickly should I pay off my home mortgage, and what method should I use to do so? There are people now touting bi-monthly mortgage payments, where you pay 2 payments a month, and all kinds of different strategies. So we're going to talk about in this segment of the video, not only the issue of whether or not you should pay off your home mortgage early, but which method might make more sense to you based on your circumstances. First of all, I think it goes without saying that before worrying about paying off your home mortgage, you should be paying off all of those high interest rate credit cards and consumer loans that you have. It doesn't make a lot of sense to be concerned about a 9 or 10% mortgage when you have an 18 or 19% credit card or consumer loan that is still outstanding. So focus in on those loans first, and then let's talk about the mortgage interest expense that everybody seems to want to talk about. Well, on a monthly basis, hopefully, if you're following my strategies, you'll have surplus money available to you. Some people might advise that every dollar of surplus cash should go to the prepayment of a home mortgage. My advice is a little bit different. Although I would advise you to prepay your home mortgage as rapidly as possible, I would not go to the extreme of making it your #1 priority. My strategy generally follows these percentages. Of your surplus, I would take 50% and use it towards investing for the future, putting it in good, no-load mutual funds, which we'll talk about later in this program. The other 50% I would use for mortgage prepayment and debt repayment in general. Here are the two basic strategies that an individual can use to prepay their home mortgage. The first one is called the extra principal payment method. And as you see on your screen, an amortization schedule, which by the way, your bank or finance company who is holding the mortgage on your home should be more than willing to provide this for you, either for free or for a small payment. You will see this month's current principal and interest payment. And now let's go down to next month and you'll see next month's principal and interest payment. Here's what you want to do. Make this month's principal and interest payment and then simply make next month's principal payment at the same time. So every month you're making the current month's principal and interest payment and you're making next month's principal payment in addition to your current payment. What this will do is cut a 30-year mortgage down to a 15-year mortgage. Now what you will see on the amortization schedule here is that it's just a small amount of money in making that extra principal payment. It's an amount of money that just about anyone can find in their budget to be able to cut that 30-year mortgage down into a 15-year mortgage. Now as you'll see from the amortization schedule, the extra principal payment method does have one negative, which is that every month the principal amount goes up. This is the way amortization works. So in years 10 and 12 and 14 of this strategy, that extra principal payment might be a big payment to make. The second method that I use is to simply convert your 30-year mortgage into a 15-year mortgage by determining how much the 15-year mortgage payment would be right now and make that payment each and every month, as opposed to the required payment that the bank has you on under the 30-year mortgage amortization. The way this works, as you see in our schedule, is you simply would make a slightly higher payment, usually about 17 to 20% more. We'll take your 30-year mortgage and reduce it to a 15-year mortgage. These are the two methods that I suggest using to get out of debt on your home mortgage in 15 rather than 30 years. Now, one of the questions that's frequently asked when I talk about this subject is, Jim, why not just get a 15-year mortgage in the first place and not go through this difficulty? My strategy would be to get the 30-year mortgage and try to use either one of these two methods to pay it off in 15 years or even sooner. However, if you go through a difficult financial time, remember that you can always make the minimum payment based on the 30-year amortization. Nothing by law would require you to stay with this strategy. So it gives you some extra flexibility. Rather than locking yourself into the 15-year mortgage, you can go with a 30-year and use either the extra principal payment method or the conversion method by going to the 15-year payment from your 30-year mortgage. So if you're buying a new home and perhaps you're in your 30s, imagine having your home totally paid off before you reach the age of 50. Owning a home for cash is probably one of the most liberating parts of realizing financial freedom. And these two strategies absolutely work and have been used by thousands of people around the country. It really doesn't matter which one you choose, simply that you choose one, create a plan to become debt-free in a very short period of time, typically less than 10 to 15 years is practical for most people, and follow your plan, and you're one step closer to living financially free. Well, another radio program comes to an end. And you know what? It's almost time for us to say goodbye. I hope that this video has helped you and your family to move a little bit closer to living financially free. You know, we've talked about dreaming dreams and setting goals and creating financial plans. But now it's up to you. You must take the action necessary to reach your financial goals. Whether it's a secure retirement, college funding for your children, or any of the other goals and dreams that we've discussed, it's now up to you. You must take action each and every month, and I know that you can do it. If either me or my organization can help you in any way to live financially free, please feel free to call us at the following number, 1-800-PARIS-92, 800-PARIS-92. It's been a pleasure being with you. I hope this video helps you and your family live financially free. I'm Jim Paris. So long for now.
Never worry about money again. Now you can live financially free. James L. Paris, known by millions as the Christian consumer advocate and frequent guest on the 700 Club, brings you the new book, Living Financially Free, now available at Christian bookstores. Over 200 proven principles for financial freedom. You can cut your credit card interest rates in half, save 40% on auto insurance, remove negative information from your credit report. You can even buy a home with no down payment, or save hundreds a year on your life insurance. And much, much more. Living Financially Free is your personal roadmap to financial success. Marlon Maddox says, I have confidence in Jim Paris. Tony Campolo says, Jim Paris gives us the kind of practical help we need. Living Financially Free, now in Christian bookstores everywhere. From Harvest House. The preceding program has been a production of Harvest House Publishers and the James L. Paris Companies. For more information on James L. Paris, write to the James L. Paris Companies, 2270 Spring Lake Road, Dallas, Texas, 75234. Or call 800-PARIS-92.